Rob. Thank you for joining me again. Welcome back. Just reintroduce yourself to everybody.
So I'm the head of the investment advisory business at Momentum Consultants and Actuaries, and we're an institutional investment advisory unit.
Okay, thank you. So last week we saw a massive headline, 200 billion rand wiped out of the GEPF due to the conflict in the Middle East. If you're a member of the government fund, that would be a very scary number to see, because it feels like, your money just sort of vanished overnight. Is this permanent, or is it just sort of a product of market volatility and things usually self-correct?
Yeah. Okay, so I'm not entirely sure of the exact context of the comment, but it's certainly not wiped out if you don't sell. So, for example, if shares drop in value, you then sell the share and you go to cash, it's got no ability to bounce back. So if you did that, absolutely it would have been wiped out. However, that almost never happens. Certainly individuals with member choice will sometimes do that, but in a well-run retirement fund, that very, very seldom happens, if ever. So, we saw in March the market, if you were in what we call an accumulation phase portfolio, so somebody more than 5 years from retirement, their portfolio might have gone down, let's say, between 5 and 7%. In April alone, that the market bounced again and the returns came back, sort of between 3.5% and 4.5%. So already much of that value has been made up again. It doesn't mean that it's that the problem's gone. It just means that while we did see a significant reduction in the total value of funds, it wasn't crystallized, and so as markets turn, so those values come back again.
Is it fair to say this is a reflection of something that's impacting the entire industry and not specifically this specific fund?
Absolutely. Every fund would have been affected in a similar type of way, unless, of course, they had an investment strategy that was money market. But that very, very seldom happens, and it's one has to be very careful about how you structure your portfolio. So, I think a fund with 100% money market, that doesn't really exist either. So, in short, yes, they would have been impacted to the same degree.
When it comes to sort of investment strategies, are there some funds that can sort of survive these kinds of market shocks?
So in short, the members that are more than 5 years from retirement would be invested in what we typically call an accumulation phase portfolio. So it has a lot of local and global equities, and that's where you find a lot of volatility, but you also get the returns. So they would have experienced in March a reduction of about 6.5%. Having said that, in April, their returns would have come up by about 4.5%. For those closer to retirement, we have much more conservative portfolios and portfolio strategies, because we don't want that volatility. When you're close to retirement, you don't want to see your fund value fluctuating significantly. So we've got strategies in place that have much more cash and bonds and much less equities in it. So we absolutely design the strategy so that those close to retirement are not impacted as significantly as those who are far away from retirement.
So just going back to this article around the GEPF impact, the chair mentioned in that piece that they are looking at, or already started actually, moving towards investing in local infrastructure and other different type of assets, including sort of energy and all of those things. Do you think that it'll reduce the impact on volatility if that's the case, if they sort of invest in those type of assets?
Yes, just by nature, when you invest in what we call them real assets like private equity and infrastructure, the way you value them, you don't value them every day. And so just from a pure valuation and mark-to-market perspective, the returns are smoother. You generally won't have the same kind of really, really high returns. You're not likely to get a 25% return out of an infrastructure bond, but you're certainly unlikely to experience a minus 10 percent. I mean, you can, because some of these projects, if they're not carefully thought through, they can generate very poor performance, but they're unlikely to be through time as volatile in terms of the investment return. So I think from that perspective, it's spot on.
Generally, looking at the state of the economy in the world, instability has become the norm. Have there been some trends that you've seen that funds have been making in response to this volatility?
Yeah, certainly globally, we've seen significant exposure to real assets, private equity, and infrastructure, things like that. South Africa, we've notwithstanding that we've been really trying to invest in more of these, there are a whole range of reasons why we've lagged, I suppose, the rest of the world. And some of those have to do with sort of bankability of projects. There's numerous reasons, member investment choice and access to transparent pricing, things like that. I mean, I don't want to overplay those because they exist, but there are definitely ways around it. South Africa, just typically as a market, because we're so defined contribution focused, things like liquidity have played a much bigger part than they would have played in defined benefit funds like you'd find overseas. So we are behind the curve, but we're definitely trying to catch up.
Just beyond the sort of the big picture in terms of the global conversation, from a sort of a member-facing level, a lot of people obviously feeling the impact in different places, including the higher cost of petrol or the higher cost of groceries. Every day when people are buying things, they're sort of seeing that their money isn't going as further. I know we're being probably like I'm a little bit biased as somebody who works at Momentum Corporate to say that do you still feel like telling people to stay invested is still the right answer, even though things are feeling a little bit, disorienting, a little bit more expensive, and the instability sort of continues?
Absolutely. I mean, that's you absolutely remain invested. The market has gone, and through time, if you go and have a look, look over the last 30 years, there are periods where the market really performs poorly. You get negative returns, and sometimes those negative returns can be around for a while. So one has to wait them out. It doesn't mean that it's comfortable. It doesn't mean that one's blasé. One looks at one's investment strategy and says, is there anything that we've missed? Could we have done anything better? But in reality, one waits it out. When you're building your investment strategy, you give it serious consideration. You do a proper job, recognizing that these types of markets can happen. So that when they do happen, you actually we knew that this would happen, so we've told ourselves we sit tight, and so that's exactly what one does. One sits tight. You assess, is there anything we've missed, and if you haven't, then you wait it out.
I'm assuming wait it out will be your one piece of wisdom you would give to a member who's feeling a bit, terrified by the 200 billion rand number, or members of different funds.
Yeah, I think maybe one of my other pearls of wisdom might be, don't look at your benefit statement too often, because when you do that, you see the number jumping all over the place. And when that happens, you feel like you need to do something. And generally, as humans, we make bad decisions when we're panicking. And so again, one has to be aware of your financial circumstances and your situation. For those close to retirement, which would probably be a little bit more uncomfortable than those far from retirement, where one really wouldn't need to be particularly worried. But again, you have to be sensible about these things. And, in all of these cases, if you decide that you feel like you need to make a change, chat to a financial planner, chat to a financial advisor, and give serious consideration, to that. The value destruction that can happen from making timing decisions can be significant, and you don't want to do that because you didn't think it through or you didn't take advice. So that would really be my thought. Take a breath. Don't look at your benefit statement too often, and if you start panicking, just get financial advice and take a breath before you do anything. Think about it carefully.
Thank you so much. That's really great advice. Just stay away from your benefit statements. Thank you so much, Rob. It was very helpful. We hope that it helps other people if they're feeling a bit anxious about the market at the moment.
Thanks, Ravani.